you look at gold and silver historically, July and August tend to be very kind of, if you look at them in terms of a chart, seasonality speaking, they tend to be the lowest, the bottom for gold and silver. Are you anticipating such a bottom as well coming this month, and or have we already hit a bottom, or is that still ahead of us right now?
I'll tell you what. I watch these markets very closely, and everybody says the bottom is in. They've been trying. The commercial traders have been trying to cover as many short positions as possible, and of course, since the highs way back at the end of January, the price has done nothing except go down, and all that is the commercial traders trying to cover as many short positions as they can, and they reached that point about a month ago, and they've been pounding away and pounding, but they just can't get any more. And what happens is the law of diminishing returns shows up, and the traders that are long in the managed money and other reportables and small traders category, they reach a point where they say, look, we don't care how far you beat the price down. We're not prepared to sell you any more long contracts, or we're not prepared to go any more short, because we're too far below the 200-day moving averages. And once that point is reached, the commercial traders can do whatever they want. But as long as the other traders aren't prepared to sell longs or go short, the price can go no further. And once that happens, the bottom is in. And they've been, like I said, they've been pounding away now for about the last month. And I just don't think they're going to get any more. So, historically, if you want to say July is the lowest month, that's probably right if you look back over all the years. But it also happens to be this time of year right now, this particular year, where the commercial traders have covered all the short positions they can. And when the next rally will start when they allow it, which should be any time, and hopefully it was today.
Have you been seeing these increasing premiums from the bullion sites lately? I mean, what is all that about?
You're talking about the retail side?
Yeah.
I haven't seen any sign of it. It's something I only track about once a week. But one thing I do know for sure, if you take a look at the U.S. mint sales, they've been just terrible all year. And that's, the reason for that, especially in the last 2 or 3 months, is the fact that, all the dealers are just chock full of inventory. They've bought back everything from people who've been trying to sell, so they don't have to buy anymore. The last time I checked was last Saturday, and the buyback was like 10% below spot. So if they have been increasing their premiums, it certainly hasn't been by a lot, because right at the moment, the retail sector is just moribund. There's just nothing going on. So any change in the premiums would be very, very minor, in my opinion.
Interesting. What about mining stocks? Are you nibbling on any mining stocks lately? What do you think of the mining sector?
Well, I'll tell you what. Thank you for asking that question, because it's something that I watch very carefully. And as we've gone down in price, I must admit that I've been in the market. I bought something last week, and I bought something on Monday. Because I just said, this is ridiculous. The prices are so low. So I just had to step in and buy something. One thing I want to point out, Danny, is that I have the year-to-date chart in front of me, which is in my column this morning, about how the stocks are doing. Up until the end of June, which is half of the year has gone by already, gold is down 7.35% year-to-date. And the gold stocks, the Huey's down 8.15%. But if you look at the silver price and the silver equities, it's an entirely different story. Silver is down 18% so far this year, up the first half of the year. But the silver stocks are only down 2.39%. So there's a huge difference between how the silver stocks are performing versus the silver price, and the gold stocks versus the gold price. There's somebody accumulating huge amounts of silver equities. For like I said, silver is down 18%, and the stocks are only down 2.39%. And in the gold stocks, gold's down 7.35, and the gold stocks are down 8.15%. So there's massive accumulation going on in the silver stocks in order for them to be performing quote unquote as well as they are, considering what the silver price has done year to date.
That's an interesting insight. I haven't noticed that actually. What what does that portend to the rest of the metals market? Because typically when silver gold goes even higher than it would have regardless.
I'll tell you what, Danny, the markets are so managed now. Okay, everybody knows that the precious metal prices have been managed, and they've been managed for the last 50 years. And you can look at any market out there. I don't care. You look at the bond market this morning. If you take a look at the 10-year Treasury, I mean, it was going to blow sky high, but the Fed came in and smacked it lower. The dollar index is up. The Japanese yen hit a new 40-year low this morning. I mean, the entire space out there. I don't care whether you look at the dollar or you look at bonds or you look at the stock market or you look at precious metals. There's just no price discovery being allowed out there. Precious metal should be sky high right now, and the 10-year yield should be sky high, and the stock market should be in the toilet. But that's just not being allowed to happen. So to say that these markets are free and fair is there's just no markets anymore. It's as simple as that. Whatever you see on your screen right now when you're looking at any financial product is a total hallucination.
Well, we know how they kept the oil price down, and that was by releasing from the SPR, from the Strategic Petroleum Reserve. Now you're looking at $68 WTI, and you couple that with the fact that oil is an input cost for these mining stocks. The fact that it's been split in half essentially from what it was a few months ago. I mean, isn't this even more tailwind for mining stocks?
Well, there's no question about it. Diesel fuel and oil and stuff like that, and lubricants and the hydrocarbons are very important to the mining industry, but they're only a very small portion of the overall cost of mining whatever they happen to be digging out of the ground. So yes, it certainly helps, but it certainly helps the bottom line of the companies. But most of these companies, if they're buying oil or whatever or gas, they've got long-term contracts locked in to buy fuel at whatever price. So these changes in fuel, although on the surface they appear to help, it really doesn't make that much of a difference in the mining shares. And besides which, like I said, the mining shares and the precious metals are so heavily managed right now that any improvement that you see because of lower oil and gas prices is masked by the manipulation of the precious metals themselves. So it would be nice to say there's a correlation, but in such a managed market, it's impossible to tell.
How do you invest in a managed market?
How do you invest in a managed market? Well, you just I've been fully invested in the precious metals for 20 years. And of course, after 20 years, you're obviously up quite a bit. So I'm very happy about that. But you have to look at these what I call the wash, rinse, and spin cycles, when the commercial traders allow prices to rise up to huge heights like they did until the end of January. Because during that time period, while prices were rising, they were covering the short positions. And once they got as many short positions covered as possible, then they killed the price and covered more short positions on the way down. So you look for the bottoms of the market. And it's not just me that says that the bottoms are in or close to being in or whatever. Everybody out there that you have on your show or in other podcasts are saying basically the same. You buy when blood is running in the streets. I don't know who said that, but that quote is from hundreds of years ago. And you buy when others are. I think Warren Buffett said, "You buy where others are afraid to buy, and you sell when others won't sell anything." So. This is the bottom of the market as far as I'm concerned, and how high we go from here is entirely up to what the big traders allow the price to go. So, like I said, I was a buyer last week and I was a buyer this week, and I can tell you right now, when I get off the phone, if prices continues to slide, I'm going to be a buyer before the markets close in about 50 minutes.
With everything being down, Ed, you've got the stock market showing weakness. You've got gold and silver showing weakness over the last several months. Energy showing weakness. Bonds showing weakness. What does that imply? I mean, where is the money going to? It seems like all of these asset classes are showing weakness.
Okay, let's take a look at this thing from the 30,000 foot level. We are living in the biggest financial and paper bubble the world has ever known. It far exceeds 1929, the tulip mania and the subsea bubble and the whole nine yards. We have never been in anything like this before. So everything you see out there, like I said before, is just a total fantasy. Any number you look at on your computer screen today, is whether it be the stocks or the bonds or the value of the currencies or gold or silver prices. You know, you look at this and you wonder what you wonder what you should invest in and why things are acting the way they are, and it's because everything's being managed. This has been going on now since. Nixon took us off the gold standard, took the gold exchange standard back in '71. And we've been living in this paper fantasy world ever since, where the central banks of the world have been printing money hand over fist. And everybody knows what the dollar index or the currency charts look like. It's parabolic from upper left to, from lower left to upper right and heading to the moon. This can only last so long before the entire system blows up. So, you look around and you say, what should you invest in? Well, you can either be out of the market entirely, or you can be invested in the two hard asset commodities that have been money through all of recorded history, silver and gold. And, everybody listening to this podcast knows that, they're invested heavily in this sector. And when the smoke clears, the only thing that'll be left standing are the two reserve assets that nobody can run off on a printing press.
So they have been managing the gold and silver market, but what you'll notice is that right now it seems like the new floor has become the old high. Now, I asked you a little while back, how do you invest in a managed market? How do you invest in a rigged market? And you said something along the lines of, well, I've been doing this for 30, 40 plus years. And so in the long run, they can kind of keep the price sequestered within a certain range, but in the long run, they can't keep it at that same range. So what $10 was or $15 was 10 years ago is now $50. Is that the new floor now? I mean, is that how effectively they lose control over this stuff? Is this gradually over time?
Well, like I said, the commercial traders have been pounding away trying to cover as many shorts as they can. They've reached the bottom now. They have been able to improve their position now for the last month or so. So unless the longs are prepared to sell or go short, the price can't go any lower. I don't care how hard they try. So if I had to bet a proverbial $10, I'd be happy to put it on the table and see we've seen the lows for this move down. And how high the rally goes from here, which will inevitably begin, okay, at some point when it's allowed, I have no idea, but I can tell you right now that everybody knows that's listening to this podcast that, silver should be at some fantastic 3-digit price right now. And gold is, as far as I'm concerned, should be many multiples of what it is already today. So, yeah, this is the thing. They can't get the price any lower, and from here it's only up, and it's only up and away from here. And how soon that begins is up to the powers that be, the big 8 commercial shorts, and how high it goes is up to them as well. Like we just saw at the end of January when they let silver get up to 120 before they killed it. But what you see out there, like I said, they control the price on the upside and the downside, but at some point, along with this supposed silver deficit we've been looking at for the last 6 years, the supply-demand fundamentals in silver, and along with that in gold too, because the run for gold now is just as incredible. They can only keep a lid on this thing for so long. You have to remember back in 1975 when they set up the paper market and the COMEX for gold. The population of planet Earth was a lot smaller than it is today. That's the first thing. And secondly, Russia, China, India, the entire rest of the world were financial and economic basket cases. And here we are 50 plus years later, and these countries, have all risen from the economic and monetary ashes and are going concerns, especially China. So when they dug up this price management scheme back 50 plus years ago, they never even gave any thought to think, how are we going to get out of this thing when the whole thing, when everything when we have to get out of it. They never gave any thought to that. Well, we're living through the process of getting out of it now. And the central banks of the world, China, Russia, you pick the country, they've been adding to their gold reserves, and there just isn't enough gold to go around. And sooner or later, we're going to have the same problem in gold that we have in silver. And once the physical market runs out, then after that, the sky's the limit as far as I'm concerned. It's just a matter of when it's going to happen.
So you anticipate a deficit in gold as well?
Hey guys, quick pause from the podcast, but this is something I feel is really important to let you in on. Back in 2020, before I even started this channel, I was looking for an edge, a way to find the big opportunities most investors never even hear about. That's when I found Capitalist Exploits Insider. From day one, it felt like I suddenly had my own team of world-class market pros working for me, digging up trades all over the world, doing the deep research, and handing me ideas that had massive asymmetric upside. Stuff that I would never even think about. Since then, my gains with them have blown past the S&P and the NASDAQ, and it's honestly the single best newsletter I've ever subscribed to. And that's not me blowing smoke. That's for real. I've interviewed their publisher, Chris McIntosh, more times than I can count. In fact, my latest conversation with him is linked in the description box down below if you want to check that out, as well as a pinned comment. And every time, I'm reminded why I've stayed a member for years. Right now, they're offering a special $1,000 discount on the Insider subscription, but it's only for Capital Cause and viewers, so you're only going to get it by clicking the link down below in the description box or the pinned comment. You're not going to find this anywhere else. Click the link, lock it in, and start getting the same game-changing research I've been using since 2020.
Absolutely. I mean, you take a look at what the central banks are absorbing, what was over 1,000 tons a year. You know, we're on a thin edge of the wedge as far as not just silver, but gold and platinum. There's structural deficits in both platinum and palladium as well. So, you know, the demand out there is far greater than supply. It's just that as long as the 8 traders control the price in the COMEX futures market, it doesn't make any difference what the supply-demand fundamentals are. The only time it'll make a difference is when we actually physically run out of something, and everybody's waiting for that to happen in silver, like me and you and everybody else. That day hasn't yet arrived, but sooner or later it's going to.
Yeah. Well, with all these metals just like reaching deficits, you would think that they would provide greater opportunities to create more supply, investing in more mining projects, but aren't we still seeing a kind of like this starvation in capital expenditure in the mining space as well?
Well, you're certainly seeing more investment than we have recently because of the big run up in price. But the fact of the matter is that if you take a look at the amount of gold that's being discovered versus how much is being consumed every year, I mean, all the exploration work out there is only discovering a small fraction of the amount of gold that has to be found to replace what is being dug out of the ground now. There hasn't been a monster deposit of gold found in the last 10 or 15 years. And even if they do find it, it's going to take them another 10 years to bring it online. So, they can invest all the money that they want in bringing a mine into production. But the fact of the matter is that, how much gold is being consumed every year? 125 some million ounces. I can't remember exactly what the number is. That's how much is dug out of the ground now. And I can tell you that in the last 5 or 8 years or so, they haven't come close to discovering that amount of gold to replace what's being consumed every year. So sooner or later, it's going to come up and bite them. And the same situation exists in copper as well. We need 3 or 4 or 5 times the amount of copper that we're currently mining, and they're just not finding it. And there's another product I don't want to get into, which I call the big 6 commodities that the boys in the COMEX are shorting and actively suppressing the price, and that's copper. It should be far higher than it is now, but they're just not allowing it to happen despite what the supply-demand fundamentals are in it.
Isn't a big part of that also China hoarding copper too? And so like there's this race to accumulate as much copper on both sides, from China's side as well as our side. So both parties kind of benefit from a lower copper price.
Yeah, I'll tell you what. I'm not sure what China's hoarding or what they're not hoarding. I mean, they play their metal cards very close to their chest, and they probably are in copper. I just don't know. Everybody suspects, at least I certainly do, and I know Alistair McLeod suspects the same thing, that China holds north of 20,000 tons of gold that they're just not reporting. So what China is doing in the copper space or in the silver space, in the gold space, I have no idea whatsoever. But one thing is for sure is that when they do decide they're going to announce how much gold they got, it's going to change. It's going to change a lot of things in a hurry.
So you mentioned the 10-year yield or the yields on bonds earlier in the program. I'm looking at the 10-year today. It just about hit 4.5%, then got rejected at that level. Japanese yields are also spiking to all-time highs. So you've got interest rates going up because no one is buying the bonds, and there's like this mysterious force field that stops it from going over a certain level. Earlier today, you had the new Fed chair, Kevin Warsh, talk about how inflation has to be dealt with, for lack of a better term. He didn't really hint at rate cuts or rate hikes, but the fact that he brought up inflation implies that he intends to deal with it. So that implies rate hikes. Is that what we're looking at in the near term future? Do you anticipate greater rate hikes as opposed to rate cuts? And what does that apply for metals? How do metals perform in a rate hike environment versus a rate cut environment?
Well, when you're looking at currency debasement the way we are now, and the death of fiat currencies, because we're well along in that process right now, raising interest rates won't make any difference, because people are going to recognize the fact that the governments are raising rates is because they just can't attract enough capital. People are fleeing the bond market because they can see that the government is now in a print or die mode, and now it's becoming print and die. As you mentioned about the 10-year yield, I saw it peaked at 4.501, and the reason it didn't go any higher, and that is the Fed that came in and bought up the 10-year, and they've been in active yield curve control now for the last 2 or 3 years. They haven't let it get above, I think it was 4.92 or something like that a couple of years ago, and they've never allowed it to get above that. Mm-hmm. But as far as interest rates are concerned, we're going to see, if we see interest rate rises, that's certainly par for the course as they try to save their currencies. Like you pointed out with the Japanese, I have a story about it in my column for tomorrow. It hit a 40-year low or something like that. Yep. And Japan is so far behind the curve, they have to raise rates. But it's just active desperation by a central bank when they have to raise rates, when the Japanese debt is as high as it is. The smart money out there can see that all governments of the world are printing themselves into oblivion, and raising rates is in just trying to prevent the inevitable. So I think this time around, we're going to see if interest rates rise, it's not going to have any effect on the price of gold and silver, because they're going to rise as well, because people can see that the price of the value of the purchasing power of paper money is heading towards zero, which is why over the last 3 or 4 years the prices have risen as much as they have. And this downdraft we've had in the last 3 or 4 months is just we've hit the low, and from here, as far as I'm concerned, it's onward and ever upward, regardless of what interest rates do. And Kevin Warsh, when he spoke, I think it was at 9 o'clock this morning, he was in Spain or Portugal or someplace like that, and he spoke at ECB. Yeah, at ECB and the British Central Bank and stuff like that. He spoke there, and that's when the gold and silver took off, was about shortly after 9 o'clock Eastern time this morning. So, they certainly were reacting to this inflation thing. And the fact that he even brought it up, indicates that it is a concern. And of course, we all know that inflation is there, and that the numbers, the inflation rate that the BLS is coming out with every month is basically BS, and everybody knows it's higher than it is. We're reaching the end of this fiat currency system, regardless of whether it's a Canadian dollar, US dollar, the British pound, or the euro, whatever it is. And, that's being reflected in the gold price. And it's only going to get bigger and badder from here. So as far as I'm concerned, like I said before, and everybody else in the world has said, when this is when this is about to come down, the only place to be is in the precious metals, and that's where I am.
So here in America, we've got a debt of about 40 plus trillion dollars. There's this idea. I mean, I'm sure you've heard of it. Gold revaluation. If you revalue the gold from $42, which is what's on the Treasury's balance sheet today, to $4,000 or whatever the market price is at the time that they revalue it, then you get about two or so trillion dollars in. You can kind of slash off the debt. But 2 trillion out of 40 trillion dollars is still a small percentage. But what do you think of this notion of gold, the Treasury revaluing its gold? I mean, do you think it's
that's
feasible?
Like $2 trillion is, I hate to say it, but it's basically coffee money when you're talking 40 trillion. Yeah. I mean, we're talking, just think about what you're saying here, $40 trillion. There's just, and it's going
5%,
up about
5% of the debt.
Yeah, it is. They would have to revalue gold to $30,000 or $40,000 an ounce to make a really big difference in the debt. And of course, if that happened, it would, the price, we'd see sky high inflation. And whether or not they're going to do it, I don't know. Nobody knows. They're talking about a 50-year bond repayable in gold on July the 4th. And I see China stopping gold trading on the SGE for if you're trading paper products or whatever. That's happening on July 24th. But the big thing is the call options for $20,000 call options in December. The $10,000, $15,000, and $20,000 call options. There's tens of millions of dollars bet in December that we're going to see gold price that, a 5-digit gold price of some kind. Wow. And that's what I'm really watching, because somebody's, there's been investors in there just snapping those things up. I remember back in February, when I first heard about it, there was 20,000 call options in December for December gold, and now it's up to over 30,000. So there's some serious money being bet that we're going to see a fantastically higher gold price before the end of the year. And the powers that be are trying to hide it, but let's face it, this currency system that we live in, this paper monetary currency system we've lived in for the last 50 plus years, is about to come to an end. I remember when Nixon got on Bonanza, came on in the middle of Bonanza on Sunday night and said, we're temporarily closing the gold window. Well, here we are 50 some years later, and the chickens are all coming to home to roost in the fiat currency system. And how they get out of this, I don't know. But I can tell you for sure that it's going to result in a fantastically higher gold price than we have today.
Well, we're already halfway through the year and sitting at $4,000 gold. So if that does happen, I mean, that would be a massively violent move in the price of gold, and surely silver will follow suit.
Yeah, they'll announce it. There'll be some sort of news event, and they'll come in, and Trump will come on and say this is what's going to happen, just like Nixon did back in August '71. They'll say, okay, fine. Then when the markets open tonight, gold will be repriced at whatever, and the COMEX will close, the LBMA will close, because those short just won't be able to meet the margin calls, and it'll blow up the entire market. So I don't exactly know how they're going to handle it. All I know is that they've reached the end of this fiat currency system and the price repression scheme and the precious metals and all commodities in general. And how they get themselves out of this, I don't know. But it's going to be a monumentous event when it happens. And people talk about the Great Reset. That will be it.
The biggest takeaway from this discussion is Ed Steer's belief that the recent decline in gold and silver prices is nearing its end. He argues that commercial traders have already covered most of their short positions and are no longer able to push prices significantly lower. While gold and silver have historically experienced seasonal weakness during July and August, Steer believes this year may be different because market participants are refusing to sell at these depressed levels. He points to unusually large call option purchases targeting gold prices above $10,000 and even $20,000 by the end of the year as evidence that sophisticated investors are expecting a major move higher. Whether or not those forecasts prove accurate, the interview suggests that confidence is building among some institutional investors that precious metals may be approaching an important turning point after months. Another major theme from this interview is the growing disconnect between physical supply and market prices. Ed Steer argues that while gold and silver prices remain under pressure, the underlying fundamentals continue to strengthen. Central banks around the world are purchasing record amounts of gold. New discoveries of major gold deposits have become increasingly rare, and mining companies are struggling to replace the metal they produce each year. He also highlights the surprising resilience of silver mining stocks, which have significantly outperformed the price of silver itself. According to Steer, this could indicate that large investors are quietly accumulating positions ahead of a potential rally. His broader argument is that supply shortages cannot be ignored forever, and eventually the physical market, not paper trading, will determine where precious metals are priced. Perhaps the broadest message from this conversation is the concern over the long-term stability of the global financial system. Ed Steer argues that decades of rising government debt, aggressive money creation, and central bank intervention have distorted financial markets and weakened confidence in fiat currencies. In his view, gold and silver remain the only true monetary assets that cannot be created by governments at will. He believes that if confidence in paper currencies continues to erode, precious metals could experience a dramatic revaluation. While these views are speculative and represent Steer's perspective rather than established fact, they reflect a growing belief among some investors that hard assets may provide protection during periods of financial uncertainty. The interview ultimately frames gold and silver not simply as investments, but as insurance against potential instability in the global monetary system.